Principles and Practice of Auditing 5th Semester. Syllabus. Module 03, Verification and Valuation of Assets and Liabilities. Meaning and objectives of verification and valuation. Position of an auditor as regards the valuation of assets. Verification and valuation of different items of assets, land and building, plant and machinery, investment, stock and trade. Verification and valuation of different items of liabilities, bills payable, sundry creditors and contingent liabilities. Meaning of verification. Verification refers to the process of checking or confirming the truth, accuracy, or validity of something. Ready. Meaning of valuation. Valuation refers to the analytical process of determining the current, or projected, worth of an asset, investment, or firm. Meaning of verification and valuation of assets. Verification of assets involves checking if the assets listed in financial statements are real and owned by the company. Valuation of assets is determining their worth and ensuring they are correctly valued in the financial records. Meaning of verification and valuation of liabilities. Verification of liabilities refers to the ensuring that the listed obligations in financial statements are truly exist and checking if they are accurate. Valuation of liabilities involves determining their correct worth or amount, making sure they are correctly valued in the company's records. Objectives of verification and valuation of assets. Verification of assets. 1. To confirm existence. 2. To verify ownership. 3. To validate valuation. 4. To enhance reliability. 5. To provide assurance. Explanation. 1. To confirm existence, ensuring that the listed assets physically exist. 2. To verify ownership, confirming that the assets belong to the company. 3. To validate valuation, ensuring accurate and reliable valuation of assets. 4. To enhance reliability, boosting confidence in the accuracy of financial statements. 5. To provide assurance, offering stakeholders confidence in the reported financial position. Objectives of valuation of assets. 1. To determine accurate worth. 2. To reflect transparency. 3. To support decision-making. 4. To comply with accounting standards. 5. To maintain financial integrity. Explanation. 1. To determine accurate worth, establish the true economic value of assets. 2. To reflect transparency, ensuring assets are valued correctly in financial records. 3. To support decision-making, providing reliable information for strategic planning. 4. To comply with accounting standards, adhering to guidelines for consistent reporting. 5. To maintain financial integrity, contributing to transparent and reliable financial reporting. Objectives of verification of liabilities. 1. To ensure existence. 2. To validate accuracy. 3. To comply with regulations. 4. To prevent fraud. 5. To enhance credibility. Explanation. NathRed. 1. To ensure existence, confirming the existence of liabilities listed in the financial statements to prevent omissions or inaccuracies. 2. To validate accuracy, verifying the accuracy of liability amounts to ensure that financial reporting reflects the true obligations of the company. 3. To comply with regulations, confirming that liabilities adhere to legal requirements and regulatory standards. 4. To prevent fraud, acting as a control measure to deduct fraudulent activities related to liabilities and obligations. 5. To enhance credibility, establishing credibility in financial reporting by accurately representing the company's obligations. Objectives of valuation of liabilities. 1. To determine true value. 2. Support decision-making. 3. To facilitate comparisons. 4. To reduce risk. KV. 5. To comply with accounting standards. Explanation. 1. To determine true value, assessing liabilities at their accurate worth, reflecting the actual financial obligation of the company. Petty. 2. Support decision-making, providing reliable information for management decisions related to financial planning and resource allocation. 3. To facilitate comparisons, ensuring consistency in liability valuation for meaningful comparisons over different periods or with other companies. 4. To reduce risk, identifying and managing risks associated with misvaluation or inadequate valuation of liabilities. 5. To comply with accounting standards, adhering to accounting standards to maintain uniformity and transparency in financial reporting. Position of an auditor in valuation of assets. 1. Independence. 2. Audit procedures. 3. Communication with management. 4. Documentation. 5. Compliance. 6. Reporting. Explanation. 1. Independence. Auditors must maintain independence to objectively assess and validate the valuation of assets without bias, unfair. 2. Audit procedures. Conduct thorough audit procedures, including inspection, inquiry, and confirmation, to verify the accuracy of asset valuations. 3. Communication with management. Engage with management to understand and address valuation methods. 4. Documentation. Keep detailed records of audit procedures and evidence. 5. Compliance. Ensure that the company adheres to relevant accounting standards and regulatory requirements in the valuation of assets. 6. Reporting. Provide a clear and transparent report on the accuracy and reasonableness of asset valuations in the financial statements. Verification and valuation of different items of assets. 1. Land and building. 2. Investment. 3. Plant and machinery. 4. Stock in trade. Explanation. 1. Land and building. Verification. Physical inspection of properties, examination of title deeds. Valuation. Consideration of market value, depreciation, and any impairments. Auditor's challenge. Ensuring existence and legal ownership, assessing the impact of changes in property values. 2. Investment. Verification. Confirming ownership through third-party statements, reviewing investment agreements. Valuation. Fair value assessment based on market prices or valuation models. Auditor's challenge. Evaluating the reliability of market data, understanding complex financial instruments. 3. Plant and machinery. Verification. Physical inspection, examination of maintenance records. Valuation. considering depreciation, assessing current market values. Auditor's challenge: identifying outdated machinery and determining accurate depreciation rates. 4. Stock in trade. Verification, physical counting, reconciliation with inventory records. Valuation, cost or market value, considering outdated or impairment. Auditor's challenge: ensuring completeness of stock count, assessing the accuracy of valuation methods. Conclusion: accurate verification and valuation of these asset categories are critical for presenting a true and fair view in financial statements. The auditor's role is to navigate challenges, maintain independence, and provide stakeholders with confidence in the reliability of reported asset values. Verification and valuation of different items of liabilities. 1. Bills payable. 2. Sundry creditors and 3. Contingent liabilities. 1. Bills payable. Verification, examination of documentation, confirmation with creditors. Valuation, recognizing the face value of bills, considering any discounts or interest. Auditor's challenge, ensuring existence and authenticity of bills, assessing the timing of payments. 2. Sundry creditors. Verification, confirmation with creditors, reviewing invoices and agreements. Valuation, recognizing the actual amount owed, considering any discounts or settlement terms. Auditor's challenge, confirming the accuracy of amounts payable, assessing the completeness of creditors. G. 3. Contingent liabilities. Verification, investigating legal documents, communication with legal advisors. Valuation, assessing the likelihood of occurrence and estimating potential impact. Auditor's challenge, identifying and evaluating contingent liabilities, determining the effectiveness of disclosures. Conclusion: accurate verification and valuation of these liability categories are important for presenting a reliable financial position. The auditor's role involves navigating challenges, ensuring compliance with accounting standards, and providing stakeholders with confidence in the accuracy, correctness of reported liability values.